In 2024, McDonald's Corporation collected $2,013 billion in rent from its franchisees, not from selling Big Macs, from rent. The same year, the company reported $25.9 billion in total revenue, and nearly two-thirds of it came not from burgers, but from real estate. If everybody thinks McDonald's sells food, who exactly is the customer? Welcome to Mr. Finance, where money, power, and history collide, and nothing is ever as simple as it looks. Let us start with what everyone thinks they know. You invest in a McDonald's, you put it in a busy spot, customers pour in because it is McDonald's, and you make money. The brand does the selling for you, the menu is already designed, the supply chain is already built, the advertising is already running. You just need to show up and operate the machine. Over 65 million people eat at a McDonald's every single day across more than 100 countries. The golden arches are more recognizable than most national flags. You're not starting from nothing. You're buying into something that already works. But here is where the dream and the reality split apart. What most people imagine when they think about owning a McDonald's is passive income. You invest, you hire people to run the place, you check in on weekends, and the money rolls in. That version of McDonald's ownership does not exist. McDonald's specifically rejects anyone who wants to be a passive investor. They want hands-on operators, people who will be in the restaurant managing the floor, solving problems in real time. If you want your name on the door and your face elsewhere, they will not approve you. Before we even get to the money, understand what you're actually signing up for. This is a job, a very specific, very demanding, very controlled job. You just happen to be paying approximately $2 million for the privilege. When you sign a McDonald's franchise agreement, you do not own McDonald's. That sounds obvious, but most people do not fully think through what it means. You do not own the brand. You cannot use the golden arches for anything outside the specific restaurant you operate. You do not own the menu. You cannot add a new item, remove an item, or change a recipe. You do not own the pricing power. You cannot decide to charge more for a burger because your labor costs went up, at least not without navigating corporate pricing frameworks. You do not own the technology, the ordering systems, the app, the loyalty program, the self-service kiosks. All of it is McDonald's property. What you actually own in the physical sense is the equipment inside the building. The fryers, the grills, the registers, the seating. You own the things that break down, wear out, and need replacing. And here's the catch. Even those items must meet McDonald's specifications. You cannot buy cheaper equipment to save money. You cannot upgrade to something more efficient unless McDonald's approves it. The franchise agreement runs for 20 years. During those 20 years, McDonald's can change the standards and you must comply. If they decide every restaurant needs a new digital menu board system, you pay for it. If they redesign the interior and your restaurant needs to be remodeled to match, you pay for that too. These remodels happen roughly every 7 to 10 years and typically cost hundreds of thousands of dollars each time. You own the physical assets inside a building that you do not own, running a brand that you do not own, serving food you cannot change at prices you cannot fully control for 20 years, subject to standards that can shift at any point. That is the deal. The initial franchise fee is $45,000. That number sounds almost quaint compared to everything else involved, but it is what McDonald's charges just to enter the system. The real number, the one that actually matters, is the total initial investment. According to McDonald's own 2025 franchise disclosure document, opening a traditional freestanding McDonald's in the United States requires between $525,000 and $2,128,000. The range is that wide because it depends on the location, the size of the building, and what kind of site you're getting into. But there are conditions on top of that number. First, you must have at least $500,000 in liquid cash, not tied up in a house, not in a retirement account. Cash you can access immediately. Second, if you are opening a brand new restaurant, at least 40% of the total project cost must come from your own money with no loans involved. If you are buying an existing location, that percentage drops to 25%, but the expectation of personal financial commitment does not. And if you borrow the rest, McDonald's expects that debt to be fully paid off within the first 7 years, not 15, not 27. In practical terms, a person entering a mid-range McDonald's investment of around $2 million needs to show up with somewhere between $500,000 and $800,000 in their own unencumbered money before anyone will even have a serious conversation with them. This is not accidental. McDonald's designed the entry requirements to filter out everyone who is not already wealthy, already serious, and already committed to treating this as their full-time life. The financial barrier is not a side effect of the model. It is a feature of it. Even if you have the money, you still have to get approved. The selection pipeline begins with an application. That application leads to interviews, background checks, financial reviews, and an assessment of your operational background. McDonald's is specifically looking for people with management experience, people who have led teams, people who understand what it means to run a high-volume operation under pressure. Having $2 million is necessary, but nowhere near sufficient. Once you are accepted into the process, you enter the Registered Applicant Training Program. This is a minimum of 9 to 12 months of hands-on training at actual McDonald's restaurants. You are not a shadow or an observer. You are working. You are on the floor. You are learning every station, every process, every standard from the ground up. This training is entirely unpaid. You spend 9 to 12 months learning how to run a McDonald's, working full-time inside the restaurants, and McDonald's pays you nothing for it. You are expected to support yourself entirely from your own savings during this period. The training culminates at Hamburger University, McDonald's Internal Training Center, where you complete the final stages of preparation. By the time you are handed the keys to your own location, McDonald's has spent the better part of a year watching you work. They know exactly what kind of operator you are before the agreement is signed. This is why the failure rate for McDonald's franchises is extraordinarily low. Estimates put it at less than 0.5% over 5 years. The system is not designed to give anyone a chance. It is designed to give rigorously vetted, financially secure, operationally experienced people a machine that has already been proven to work. A traditional McDonald's in the United States generates on average around $4 million in annual sales. That number comes from McDonald's own franchise disclosure document for 2025, which reported the average annual sales volume for domestic traditional restaurants at just over $4 million. The drive-thru is responsible for most of it. Typically, 65 to more than 70% of a McDonald's total daily sales volume comes from the drive-thru window. The implication is significant. It means the restaurant's revenue is almost entirely dependent on speed, not quality of experience, not ambiance, not table service, speed. The faster the cars move through the lane, the more transactions per hour and the more money comes in. The business model is a volume game. Individual margins on a Big Mac or large fries are thin, but you're not selling one Big Mac. You are selling thousands a day. The moment anything breaks down, a fryer goes out, 3 people call in sick, the ordering system glitches, the throughput drops, and so does the revenue. This is where most people's mental model of a McDonald's franchise completely breaks down. You generate $4 million in annual revenue. $4 million sounds like a lot of money to most people, and it is. But by the time all the structured costs are paid, what remains is a fraction of that number, and almost all of those costs go directly back to McDonald's Corporation. First, rent. Unlike paying rent to an outside landlord, you pay rent to McDonald's itself. The corporation buys or leases the land and the building. Then, it subleases that property to you. Rent is calculated as a percentage of your gross sales, typically ranging from 8 to 15% of what you bring in, though in premium urban locations, it can reach even higher. On $4 million in sales, rent to McDonald's alone could run between $320,000 and $600,000 per year. Second, royalties. Historically set at 4% of gross sales, this fee increased to 5% starting in 2024 for all new franchise locations and stores transferred from corporate ownership. For existing operators, it remained at 4%. On $4 million in sales at 5%, that is $200,000 per year paid to McDonald's before you cover a single employee's salary. Third, advertising. Every franchisee must contribute a minimum of 4% of their gross monthly sales to McDonald's national and local advertising funds. That pays for the television commercials, the app promotions, the celebrity partnerships. You have no say in how that money is spent. You just pay it. On $4 million in sales, that is another $160,000 per year. Before you buy a single pound of beef, before you pay a single hourly worker, before you cover electricity, insurance, or waste management, you have already sent somewhere between $600,000 and nearly $1 million back to McDonald's. Then food and packaging costs. Industry data puts this at roughly 28 to 32% of sales, between $100,000 and $100,000 and from that side $180,000 on $4 million in revenue. Then labor. Quick service restaurants typically spend 25 to 30% of revenue on wages and payroll. That is another $1 million to $200,000. Then utilities, insurance, maintenance, and supplies. Add it all together and you arrive at the number that matters. Let us do this clearly. Your restaurant generates $4 million in annual gross sales. Royalties at 5%, $200,000. Advertising at 4%, $160,000. Rent at approximately 10%, $400,000. Food and paper costs at 30%, $200,000. Labor at 28%, $120,000. Utilities and other operating costs, $320,000. Total outgoing, $3,500,000. What remains is $500,000 before debt service. If you borrowed money to buy the franchise and are repaying it over 7 years, that consumes another $150,000 to $250,000 annually. What remains in a solid year is somewhere between $250,000 and $350,000 in take-home profit for a single location. Not nothing, but also not the passive wealth machine the dream version suggested, and this is a good year. This is a year where you are fully staffed, where no major equipment failures occur, where your traffic holds steady, where no nearby competitor opens up and pulls customers away. The moment any of those conditions change, the math shifts fast. Here's the thing that changes how you see all of this. McDonald's Corporation reported total revenue of $25.9 billion in 2024. Of that, approximately $15.7 billion came from franchised restaurants, meaning rent and royalties paid by franchisees like the person you are imagining yourself to be. The company's operating margin on that franchise revenue exceeds 80%. They collect the money, and almost all of it flows directly to profit. According to McDonald's own financial filings, in the first quarter of 2025 alone, the company collected $2,313 billion in rent from franchisees, compared to $1.33 billion in royalties. Rent is the bigger number. Rent from the same people who think they own a fast food restaurant. McDonald's is among the 10 largest real estate holders in the world by total assets. The company owns the land underneath approximately 45% of its locations globally and controls the buildings at roughly 70% of them. That land appreciates over time. The rent collected from it is indexed to sales, meaning as food prices rise, rent automatically rises too. It is one of the most elegant inflation hedges ever constructed inside a business model. The burgers are the mechanism. The land is the point. On paper, a McDonald's franchise is a cash flow machine with an established brand behind it. In reality, it is a 7-day-a-week operation that demands your constant presence. The single biggest operational challenge is staffing. The quick service industry has extraordinarily high employee turnover. In some markets, a single McDonald's location hires and loses dozens of employees over the course of a year. Every new hire needs training. Every training takes time. Every gap in coverage becomes a bottleneck in a business where everything is measured in seconds. Customer satisfaction at McDonald's is not evaluated by how good the food tastes. It is evaluated by how fast the food arrives. A drive-thru that takes 4 minutes is performing better than one that takes 6. McDonald's tracks speed of service as a core metric in locations that fall below standard face consequences from corporate. This is not a business you manage from a distance. Here is one of the most important things to understand about McDonald's franchise economics, and it is something you have almost no control over. Location determines outcome more than almost any other variable. A McDonald's at a high-traffic highway interchange will generate dramatically more revenue than one in a declining strip mall 5 miles away. That is not a preference. That is a structural economic reality. The same brand, the same menu, the same training, the same corporate support, different location, completely different financial result. McDonald's controls the location selection entirely. The corporation uses advanced data analysis, traffic patterns, population density data, demographic projections, proximity to competitors to identify where new restaurants should go. You do not find a location and bring it to McDonald's. McDonald's identifies a location and presents it to you on a take it or leave it basis. This is not an accident. McDonald's did not become one of the largest real estate holders in the world by letting franchisees pick where the properties go. The corporation has spent decades acquiring prime real estate, and the franchise system is in part the mechanism by which they get someone else to pay the operational costs of running businesses on that prime real estate. The 5-year survival rate for a McDonald's franchise is estimated at around 98%. To put that in context, roughly half of all independent restaurants in the United States close within 5 years. McDonald's is operating in a completely different universe of risk. 3 main reasons. First, the brand. When a customer pulls into a McDonald's parking lot, they already know what they are going to get. That predictability eliminates a huge portion of the uncertainty a restaurant typically faces. Second, the supply chain. McDonald's exclusive distribution relationships secure massive buying power. A single franchise location benefits from the negotiating scale of 45,000 locations worldwide. Your cost for beef and buns is far lower than it would be if you were buying independently. Third, the system itself. Every process inside a McDonald's kitchen has been optimized over decades. Cooking time standardized, assembly sequences standardized. This is why you can walk into a McDonald's in Atlanta and one in Manchester and get the same fries cooked to the same temperature in the same amount of time. The system is the product. That is why it survives. One McDonald's generates $250,000 to $350,000 in annual profit in a solid year. That is a good income. It is not a path to significant wealth by itself. The people who build genuine financial scale inside the McDonald's system do it through portfolio ownership. They do not stop at one restaurant. They operate 5, 10, 20 locations. At that point, the economics shift fundamentally. Fixed overhead costs, accounting, legal, human resources, back office administration, get consolidated across the portfolio. Instead of paying for 5 separate accounting teams for 5 stores, you build one efficient central operation that manages all 5. Labor can be optimized across multiple locations, pulling experienced staff from higher performing stores to support struggling ones. The borrowing power required to expand is easier to access once you have demonstrated consistent performance across existing locations. An operator running 10 average performing McDonald's locations, each generating $300,000 in annual net profit, is making $3 million a year. That is the model, not one store, a portfolio. The very best operators in the McDonald's system run 30, 40, sometimes 50 restaurants built over a decade or more within the framework of someone else's brand on property controlled by someone else's company under rules set by someone else's executives, but generating 8 figures of annual income nonetheless. 3 risks tend to get glossed over in the sales pitch. The first is labor legislation. In 2024, California set the minimum wage for fast food workers at $20 per hour. For California franchisees, the jump in labor costs was immediate and severe. An operator running 40 hourly employees saw their annual labor bill increase by hundreds of thousands of dollars in a single year, while royalties and rent to McDonald's stayed exactly the same. When your fixed costs hold steady and your variable costs spike, the profit compresses fast. The second is economic disruption. McDonald's is often called recession-proof, and there is some truth to that. People do trade down from pricier restaurants when money is tight, but if a franchisee is carrying significant debt from the initial investment, a sustained period of reduced revenue can tip an otherwise viable business into real difficulty. The third is corporate decisions you have no vote on. McDonald's can mandate expensive technology upgrades. They can require a full interior remodel at a cost of several $100,000. In 2026, McDonald's began rolling out standardized pricing tools constraining franchisee flexibility on local promotions. Every one of these decisions lands on your balance sheet. You did not vote for them, you just absorb them. There is a lawsuit worth knowing about because it illustrates the power dynamic inside the system with unusual clarity. George Mitchell operated 37 McDonald's restaurants. He was a highly successful franchisee. By any external measure, exactly the kind of operator the system is designed around. But in 2025, he sued McDonald's Corporation, alleging the company was using its internal performance review standards to deny him franchise renewals and pressure him into selling his locations at below market prices. The courts dismissed his contract-based claims with clear reasoning. The franchise agreement, the judge found, grants McDonald's absolute discretion to modify operational standards at any time and makes no promises about renewal at the end of a franchise term. McDonald's had the legal right under the contract he had signed to change the rules of the game and declined to renew. This is not a story about one operator. It is a story about power. The same power structure that made McDonald's one of the most profitable corporations in history is the same power structure that leaves franchisees with far less control than the golden arches might suggest. Across the global economy, this pattern repeats itself again and again. In 2023, Uber reported that its drivers in the United States earned approximately $31 per hour on average before expenses, while the company itself generated $37 billion in revenue and posted its first full year of operating profit. The drivers own the cars, Uber owns the platform. In agriculture, the 4 largest meatpacking companies in the United States control approximately 85% of the beef market. The ranchers raise the cattle, the packers set the price. In technology, Apple controls the App Store and takes a 30% commission on most digital transactions. The developers build the apps, Apple owns the marketplace. McDonald's is not an outlier, it is a blueprint. This pattern is what economists call a platform business model. The value does not come from producing the thing itself. The value comes from controlling the infrastructure through which the thing is produced and sold. McDonald's does not need to own the restaurants. It needs to own the system. The franchisee takes the operational risk, the labor risk, the local market risk. McDonald's takes the structural profit. And because the rent is indexed to sales, McDonald's captures a percentage of every dollar the franchisee earns forever. The genius of this model is its simplicity. When you buy into McDonald's, you're not buying a business. You're buying access to a machine. The machine works. It has worked for over 70 years. But you're not the owner of the machine. You are the operator of it. The owner collects the rent. If this gave you a new perspective on what you thought you knew about McDonald's, hit subscribe. History has the answers.